Hi, Adrian Quick here again. Been asked to put together again a short sort of underpinning knowledge on financial statement analysis. Happy to do that. We'll certainly try my best for the next 10-15 minutes or so. It might take a little bit longer. One of the things that's a problem, and it is, and I confess, the real world is much more complicated than you read in books. And so I'm well aware that the material that we've got and the books that you have to read and so on will tell you how to calculate financial ratios. They will tell you that gross profit percentage is gross profit divided by sales. They'll tell you that return on capital employed is operating profit divided by capital employed. And they'll have a very nice simple income statement and statement of financial position where you can see the figures. And then you're asked to do an assignment, and you're asked to actually download a set of financial statements of a company, and obviously it's a public company because that's otherwise you couldn't get the information. And when you look at their financial statements, you think to yourself, my goodness me, you know, this is far, far more complicated. I'm not comfortable with the figures that I should be taking here. And I understand that, and there's no easy answer to it other than to say, look, you know, let's go through it. So, what I have done is to download a set of financial statements, and it's only a couple of pages, that's all it is, but obviously you can't see that, it's quite small. Now, the company is UPM. This is my old company, so at least I could talk with some understanding of what they do and the reasons behind figures and so on. UPM used to stand for United Paper Mills, but it was abbreviated. It's a Finnish company, but it's quoted on the Finnish and US stock exchanges. And what I suggest that you do, because I'm going to be talking about these financial statements, so if you haven't done it already, pause this video right now, go to Google, because I think that's the easiest thing to do, Google's answer to so many things, and type in UPM financial statements, hit that. And if I remember, about the third result down for me was a PDF copy of their financial statements. So if you do that and you download it, and I think it would really help as well if you're able to print it out, although you can put it on the screen because mainly you'll be listening and following figures that I'm talking about here. So I suggest that you do that. As I say, go to Google, UPM financial statements. Oh, and by the way, this is the latest one, so this is 2017 financial statements. So I'll give you a minute to do that, and then we'll come back and I'll talk about what we've got here. All right, so actually you will have seen a link to how to find the document. That document is a whole annual report. Obviously it has a lot of information in it as well, not only the financial statements. So you'll need to scroll down to page 57, and this is page 57 and 58. And what you should find here is a consolidated statement of consolidated income statement and the consolidated statement of financial position. Those two. Consolidated, why consolidated? Because it's a group, all right? A company can own other companies, and if they do, then obviously that's a group of companies, and it's a legal requirement to prepare a set of financial statements for the whole group. So that's why it's called consolidated rather than just for one company. My memory is well over 200 companies within the group. All right, now small print, so I need my glasses, so I'm going to just go through and see what we've got here. All right, so the first thing that I'm looking at here, consolidated financial statements, IFRS. IFRS, International Financial Reporting Standards. What does that mean? What it means is that a company like UPM, like any listed company, needs to conform to international accounting standards, and that includes how they present and how they prepare their financial reports. So that's why it says Consolidated Financial Statements, IFRS. And that's what we want, certainly, because in theory, and I will come back to that, in theory that should ensure some sort of comparability between others and help us to understand what we've got here. So the first thing I'm looking at is the consolidated income statement. And you can see here, hopefully, if you've got the same document, it says consolidated income statement, and then it starts off with the sales figures, and you've got the notes, and you can see always in this, because it's a requirement, you have this year's 2017, and then you can see 2016 next to it. Always it's a requirement in order in published financial statements to have this year and last year like that. And if you've got the right document, and I'm sure you have, the 2017 sales figure 10010, 2016 9812. Fine. Okay, so let's have a look at this income statement, consolidated income statement. What do we understand here? Well, it's actually quite difficult to get any detail without reading the notes, and that's why it takes a considerably long time to understand what's included here. And certainly we're not going to do that because we would be here for hours if we went through the whole document, and it shouldn't be necessary. But if we start with sales, the UPM is a forestry company, so it's selling paper, it's selling pulp, forestry products, it's also into energy, those sorts of things, into label papers and so on. So this is basically what it's selling, the products that it's actually selling, so that's quite clear. All right, we've got then other operating income. We don't know what that is, and because it's not material, I'm not worried, it's only 83. We then take away some costs and expenses, so these are presumably the direct costs of the business. And then we've got all these other complicated things here. And with respect, I mean, it's going to take even accountants some time to understand what's going on here. So you read things like change in fair value of forest assets and wood harvested. And you can see there that you've got income, I think, of 103. So I would understand if you're saying to yourself, well, hang on a sec, do I include that? Is that part of profit? Is that part of sales? Or what is it there? Okay, I'm not sure if it helps if I explain what it is. I will do very quickly. What that actually means is that if you've bought, let's say, a forest, so you buy a forest, I don't know, for £10,000, just to keep the number simple. In a year's time, somebody comes along, a professional values that forest at £11,000. So you bought it for 10, it's valued at 11. So you could argue you've made a 1,000 profit, a 1,000 gain on that. Yes? 10,000 you bought, it's now worth 11, so basically I've earned a profit of 1,000. The problem with that is, yes, that might be true, but you don't have £1,000 worth of cash to give to your shareholders. So what we accountants do is to call this an unrealised profit. It's unrealised. Yes, it's a profit, but it's not one that we can actually give out as dividends or something like that. So increase in fair value of those assets there. Share of results of associated and joint ventures, very small, only 5. Okay, so if we own a subsidiary, then we have control of it, more than 50% of the ownership. But what happens if we have an investment in a company where we have between 20% ownership and 50%? We don't control it, but we have what we call significant influence. Those we call associated companies. They're associates. Do we consolidate them? Yes and no. Typical accounting answer. What we do is to bring in our share of their profits. So we sort of consolidate it. You'll come across a concept called equity accounting. So this is basically the share of those companies in which we own between 20 and 50%. And you'll notice for whatever reason here they show depreciation of 450. And again you see amortization. Do we know what amortization is? If you have a fixed asset like a building or a truck, a car, those sorts of things, or a machine, then it loses value as you use it, as you hold it, and we depreciate it. Whereas if you have an intangible asset, like a patent or a trademark or goodwill or something like that, if you have, let's say, a patent for, 20 years, a patent lasting 20 years, then what you'd like to do, and you paid for it, is to write that cost off over 20 years. That's not called depreciation. We accountants call it amortization. Okay, jargon is the big barrier to understanding, so I need to clarify this. And then impairment charges, another great word, impairment. So basically we have an asset and something has happened such that its value has gone down significantly. It's not normal depreciation, it's suddenly impaired. So let's say that we had a machine that produced, some high-tech thing, suddenly there's no market for the high-tech machine that it used to make, therefore the production machine is no longer worth anything because what it's producing has no value, so we would therefore write that down, we'd accelerate the depreciation, we call that impairment. So you see the operating profit. Okay, then we have gains on sale of energy shareholding, so we've sold some shares and we've made a profit. Exchange rates, fair gains and losses as well. We have overseas subsidiaries, and you appreciate that if the value of the currency, the euro, changes against the overseas subsidiary, then the value of the subsidiary changes. If the euro strengthens and we've got a dollar quoted subsidiary, then basically we will have a loss because the value of the asset in dollars has gone down relative to the euros. So we need to provide for those exchange losses. Profit before tax, okay, and then we've got the taxes charge here, as you can see, and then you've got the profit of 974. Are we worried about what happens next? No, we're not. Basically, there are a few minority shareholders, we call them non-controlling interest is the term, in some of UPM's subsidiary companies. So we need to split these profits of 974, basically between the owners of the parent company and that non-controlling interest, used to be called minority interest. So we split that 974 like that. Fine, so that's the consolidated income statement. And then we go on to something called statement of comprehensive income. So I've mentioned that certain profits couldn't be taken necessarily to what we call distributable profits. We call them unrealized profits. And what we see here are a lot more unrealized profits. So we start off with that 974, as you can see, in 2017. Hopefully you can see that now at the top there. And we adjust that with all sorts of issues that are going on that basically are non-distributable gains or perhaps losses as well. And so what you then have is a figure called total comprehensive income for the period 937, like this. And again, we split that 937 between UPM shareholders and the minority interest and non-controlling interest shareholders. Okay, so hopefully some words as to why this is far more complicated than you're ever going to read in Attrell and McLeany or what have you. And then you'll notice here, and this is I just sometimes despair myself, the modern term is statement of financial position. So we turn over the page and I look at the next one, and what does it say? Consolidated balance sheet. I don't know why. I really don't know why they're calling it a balance sheet. This is news to me. It should be consolidated statement of financial position. And here you'll see that we've got assets on the top, and on the bottom we've got equity and liabilities, and lo and behold the balance sheet actually balances. Now for those of you who are sharp, you might like to drop a note to UPM and ask them why their published financial statements don't actually add up. I have dropped them a note to actually ask that, because if you look at 2016, before you have a go at me, it's not my fault, not this one. If you look at 2016 comparative figures, you'll see that actually they do not total to 13,911. Now admittedly it's only €1 out. It's actually €1 million out. So I'd be happy to have that 1 million, but actually they don't add up, which I find quite embarrassing, and actually I think it's shameful. But never mind, it doesn't help. It doesn't help with our financial analysis. Now, looking at some ratios, let's start off with profitability ratios. We know that with ratios we can split them into different types. So profitability. I'm not sure which is the most important one, it doesn't particularly matter, but there's certainly perhaps three that we ought to look at. And you will know return on capital employed. That is the key one. It's also one of the things, one of the main ratios that companies will put right on the front page. If you look at the summary of key data, return on capital employed. And what this ratio is telling us is how much profit essentially are we making on our investment in productive assets. I think that's a good expression, it's mine, but how much are we making in productive assets? So we've got this machinery, they make paper or they make pulp or whatever, or they harvest forests. How much profit are we actually making? Now you should know the expression PBIT, profit before interest and tax, profit for interest and tax, and sometimes we call that operating profit, profit from operations. And we divide that by the capital employed. Okay, now this one's just going to take a little minute to explain because it's key and it's slightly more complicated. If we first of all go back to the consolidated income statement, they are kind enough to give us the figures for operating profit. They're kind enough to give us that. And you can see 1259 is the operating profit for our year 2017, and then 1135 is the operating profit for 16. So that's easy, sorted. What about the capital employed? Now you can look at that in one of two ways. You can either say that the capital employed are the physical assets that we are using, net assets that we are using within the business. So that's one way of looking at it, the assets. Or the other way is, what finance do we have that is actually in the balance sheet financing those assets? Because the figures are the same. So you can either look at it from an assets perspective or from a capital perspective. It's the same thing. Do we view capital as physical, hard capital, machineries and receivables and inventories and stuff like that, or the actual money that's been put into the business in order to buy and finance and fund those? So if we look at capital employed, let me just do it for speed's sake for 2016, you can see that I've got total assets of 13,067. Total assets. But of course, what I need to do is to take away my current liabilities. And my current liabilities, because I want my net assets, 2150. So take away that sign, 2150. So if I do that calculation, you'll have to trust me because I've just done it on the calculator, and I multiply by 100, and you'll see that this one here always shows a percentage. I might have mentioned that ratios can be a percentage, they can be a something to something. You remember the current ratio, 2 to 1, 1 to 1. So you can express ratios as a percentage, as a something to something, or a ratio can be a times. Interest cover, profits are 8 times the interest, so interest is covered 8 times. So 3 ways to express ratios. The other way to look at this one here, 13,067 minus the 2165, is to look at the equity, which is 8663. So let me just do it over here. Equity, 8663, I hope you're following this in the balance sheet, and the non-current liabilities of 2254. So I hope that if you add those two together, and I know it does, it will come to what those two were as well. So this is looking at the net assets, basically, and this is looking at the financing of those net assets. Either way, we get capital employed. And if we use the figures for the previous year, 9.8, you can work that out yourselves. So 9.8 is the previous return on capital employed, the previous year. So your financial analysis is clearly going to comment that the return on capital employed has improved over this period. We are now making a higher profit on the investment that we have in our operating assets within the company. So this is an improvement. And if you want to know why, all right, that whole document of which this is a part is going to explain that to you. So so your challenge is really to go through that and find out, in this case, what Mr. Pessonen, the CEO, is telling you about what's happened within here. And he's telling you about improved market conditions and good prices and cost controls and good stuff like that as to what's actually helped that to improve. So that's return on capital employed. Key ratio. One thing that's going to be frustrating for everybody, and that is that we've just calculated those figures for return on capital employed, 11.5, 9.8, based on the statement of financial position, or balance sheet as they want to call it. If you look at the highlights, their financial highlights, you won't see those figures. They have different figures for return on capital employed, slightly higher, surprise, surprise. It would be a fair question to say, why are they different? And I'm afraid I do not know why they're different and how they have calculated it. I will come back to this, for sure I will come back to this, but what I would advise in terms of what we are doing within this module, and certainly for the assignment, in order to make the numbers traceable, and also for us to ensure that you know, you have actually calculated the ratios based on the right figures, stick to the actual financial position you know, figures there rather than the ones that they quote. What they will have done, and it will be buried somewhere in a note, is they will have taken out certain assets that they don't consider to be productive assets and so on. They would have done, I'm sorry to be blunt about it, everything they can within the bounds of the rules to make the figures look as good as possible. So that's return on capital employed. So now let's have a look at return on equity. So return on equity. So there we're not using profit before interest and tax, we're going to be using the net profit. So the net profit. So in other words, the profits that are available to the ordinary shareholders. Equity, the ordinary shareholders' investment in the company, that's what we call the equity, the interest of the ordinary shareholders. But of course, the net profits also need to provide any preference dividend. So if you have preference shareholders who come ahead of the ordinary shareholders, they get their dividend first, and in a winding up they get their money back first before the ordinary shareholders, if there's any money left. So you need to deduct the preference dividend. Now you'll notice within the company that I'm looking at, UPM, they don't have any preference dividend. So that's why I haven't considered it, because there aren't any preference shares there. And basically, you consider that, okay, as a percentage of the equity. It's as simple as that. So the figures here are quite straightforward. If you go back to your financial statements, the profit for the period, again looking at 17, hopefully you can pick up 974. So you'd have 974 for the current year and the comparative. And let's just keep the equity simple. The equity in the balance sheet, equity figure, I'm picking up 8663, and that's the equity figure, 8663. And again, if you want the percentage, multiply it by 100 and so on, but I'm telling you that comes out at 11.2%. Do the same thing for the previous year, trust me, 10.7%. So once again, we can see that the return on equity has improved. This is an improvement. If you want to know why, probably it's linked to why the return on capital employed has also improved. Fine, okay. There's quite a lot that goes to return on equity. Don't forget that the bottom here, we're taking balance sheet values of the equity. Just as a sort of a level 7 thing to consider, that if you were actually investing in the company, you would be paying the market price for the shares. You wouldn't be paying the balance sheet value for the shares. So do not believe that if you went to buy UPM shares, you would have made a 10 or 11% return on your investment. That's not the same thing. This is based on balance sheet figures. Just a warning if you've got any free money for investment. And then the last, I think the key ratio, the net profit percentage. Now this one here can be interpreted in many different ways, and I'm afraid it does, and it comes with different names and so on. So whatever you do, in many respects it doesn't matter as long as you explain what you're doing and what figures you're taking. So what I would do here, I would again go back to my profit before interest and tax. And you might want to call this operating profit percentage rather than net profit percentage, and that would be correct as well. But you often see the net profit percentage defined as that, and again, sorry about this, over the sales figure there. So taking our figures for 17, 1259 was our profit before interest and tax, our operating profit. And our turnover figure, we said, I remember it was 10,010. Multiply that by 100 to get the percentage. 12.6%, and the comparative 11.6. So we can see that all of these profitability ratios have increased. So this is very positive. In fact, UPM is doing quite well. No problem at all. All right, the other category to look at quickly, let's look at liquidity. Our assignment asks us to choose two categories. That's up to you. But if you want to make life easy, choose profitability and liquidity, because they're the most easy to comment on and most easy to find out what's going on and why figures have changed and so on. So depending on which book you read, again, you'll see that you've got 5 or 6 or perhaps sometimes 4 different categories of ratios, but profitability and liquidity. So these ones, very straightforward. We've got our 2 main ratios. We've got the current ratio. And please note, don't irritate people by making this a percentage. It isn't a percentage. The current ratio is defined as current assets to current liabilities. And if we start off with the figures, let's look at the statement of financial position, or the balance sheet as they like to call it. We've got here the current assets figure, I can see 3922, and that's what I used, and we've got the current liabilities figure again in the balance sheet 2150. So 3922 compared with 2150. Now you'll agree that whilst that's true, it's not the most friendly of way to express a ratio. So what we normally do is to convert this as something to 1. So basically if you divide that by that, divide that by that, that over that, you'll find that it comes close enough, 1.8 to 1. So that's how we would define the current ratio, 1.8 to 1, and that's easy to understand that basically we've got nearly double the amount of current assets that we have current liabilities within our balance sheet. Is this healthy? Yes, it is healthy. We know that if this ratio is quite weak, then we have probably liquidity problems, cash problems and so on. Are we going to be able to pay our debts in the short term and so on? And we know that's what causes companies problems. Okay, and then the other one that goes with this is the acid test ratio, which as we, hopefully, if we've done the reading, current assets, again, but this time we take away the inventory from current assets. Because what this ratio is telling us is really our ability to pay money in the very near future. And if included in current assets we have inventories, of course we have to sell it first, and we might not be able to do that. So therefore we deduct the inventory, and sometimes we call this the quick asset ratio, or the acid test ratio, perhaps is slightly more common, I don't know. So you take that away and compare that again to current liabilities. Current liabs. All right, so if we take let me just look at the balance sheet here. We take the 3922 and take away the inventories of 1311. Hopefully you can follow those figures. 3922, take away the 1311. So that leaves us 2254. No, it doesn't. It leaves us 2611. And we're comparing 2611 again with 2150. Do the calculation. What does that work out at? 1.2 to 1. Okay, a bit dangerous to say what are the right ratios, because the answer to that is it depends upon the company. Okay, but sort of conventional wisdom for a traditional manufacturing company, perhaps like this, 2 to 1, 1 to 1 are healthy ratios, and we're certainly within the ballpark for those. So we would be happy with the liquidity situation for this company. Has it changed dramatically? Well, if you do the comparative figures, you actually get very, very similar results. So the liquidity hasn't changed within the company. So this is good. It might also indicate, that they're managing working capital efficiently. It might indicate that. So be it. All right, so those are the two ratios. And I just quickly wanted to have a word about gearing. Basically, the gearing ratio compares within the financial structure the amount of debt as a percentage of total finance. So in simple terms, I don't know whether you're going to thank me for this or not, it's debt over debt plus equity. And again, I'm always lazy with the times 100, but this one is always expressed as a percentage as well. So if we just keep life simple, if you look at the net debt within the balance sheet here, non-current liabilities, that's what we want, our long-term debt capital, 2254 over 2254 plus the equity, and the equity figure we've got here, 8663. Make that a percentage, 20.6%. And by the way, if you do the year before, you get 29.0%, by the way. So what's this telling us? That here, obviously, the gearing has reduced. Is this a good thing? It's neither good nor bad. Okay, the levels are not excessive either way, but what it basically means is that the company has become less financially risky. There's less of a commitment to paying interest on capital. Don't forget that for dividends, you don't have to pay the dividends, interest you do. So the higher the level of debt, the bigger the financial risk. So here we can see a reduction in financial risk for the company. So obviously, again, if you read, what they did was that they paid a significant tranche of long-term debt back again. At the risk of destroying everything that I've done, there are something like, I think I read somewhere, 160 definitions of operating profit percentage or something like that. Because of the variety of what's in the accounts, the variety of what businesses do, what they consider they can include and not include. Just a quick word on the gearing ratio here. Just a quick word. Quite often you will see gearing calculated, and it's quite correct, as not only debt over debt plus equity, but what they actually do, for reasons I'll quickly explain, is they have net debt over net debt plus equity. Because if you think about it, if you have a large amount of cash within the balance sheet, what you could argue is that you could use that to repay the debt straight away. So in fact, it's too simplistic to say it's simply debt over debt plus equity. It's net debt. And if you actually look at the balance sheet here, if you look, and you look at the debt, the non-current liabilities of 2254, if you look at what you've got in there, you've got, first of all, deferred tax liabilities. Do we understand that? We probably don't. But basically, that is tax that you are going to pay in the future. If you invest in an asset, right, you can basically get tax advantages. You can deduct the cost of that asset or part of the cost of that asset against your profits. But of course, you're charging depreciation on the asset. So you've got a timing difference between the profits that you post in the accounts and what the taxman says you can and can't claim. So basically what you're doing here is to put off a tax liability by claiming those what we call capital allowances. And therefore this is tax you're going to have to pay in the future as that reverses. Is that a long-term debt? You can argue either way. Net retirement benefit liabilities. Goodness gracious me, don't have these in the books either. What on earth are we talking about here? Well, the net retirement benefit liabilities, what UPM have done, which is actually very honourable of them, is to include their pension liabilities within the main accounts. If you wind the clock back to Robert Maxwell and the Daily Mirror scandals and so on, the pension fund was totally different, and what he was doing, in fact, he was borrowing money from the pension fund, which busted, and then Mirror Group people lost their pensions and so on. What UPM and other companies have been encouraged to do is to actually include those pension, because most pension funds are actually underfunded, so they don't have enough money in investments in order to pay out future pensions, but this is based on projections for the future. So what they've got here is basically those future pension liabilities, the underfunded element, I think that's 736. Is that really net debt? Are they using that money to finance the company? The argument is, well, they should pay it, and therefore if they're using it, not paying it, they're using it. You can argue either way. And so it goes on. And then what you basically got actually is non-current debt of 789. So instead of having 2254, there's a strong argument here to take 789. And then if you look on the asset side, how much cash have you got? You've got cash and cash equivalents, 716. So suddenly, you know, if you're talking about net debt, you've got here 789 as actual long-term debt, 716 as short-term assets to offset against it. So effectively, you've got very, very little debt. So you can see that these ratios, what I'm saying, one, they're more complicated, and two, there's various ways of looking at them, which is why when you look at published figures, it could take you a long time to see how they've calculated them. So my strong advice in all of this is keep it simple, because at the end of the day, this is, you know, we're not going to be financial experts in this. Keep it simple. Stick to the formulas that we have got, and provided you stick to that for the 5 years consistently, I don't think you can be faulted in what you're doing. So I don't think there are well, I suppose there are some other funny things here, But maybe we don't have to go into any more detail, thank goodness, because I think what I was able to do was to go through our main ratios, picking out the headings from the income statement and the balance sheet here, and all this nasty detail doesn't really need to be considered, but at least I've sort of touched on some explanations for it. So I hope that was helpful. If you are watching this, what I will do certainly before the end of the course is to have an interactive tutorial, and we'll talk in more detail, hopefully questions and answers about how we can best answer this assessment. So I hope that was helpful. Good luck.